Yeah.
Shawn if she can see a start.
Shawn, are you able to check to see if you see a start button on your side?
Oh man,
for some reason it's not letting. It's not letting us on this side, and I don't know why.
Let me see. People can hear you. Click. No, that's just you.
I do.
Why
On
don't
this side, I can see it says this session is being recorded, if that helps you guys at all.
Yeah, I see it here too, but for some reason it won't let me start. It's just for some reason we were supposed to hit *1. We've done that, but it's not moving.
Oh, okay.
I don't know.
What's
Tony,
not
are you
moving?
dialed? I've had this happen before. Tony, are you dialed in by phone? Whoever the organizer is, or on my account?
Yeah, usually we just by phone.
Okay, sorry, I don't see like the phone option on. I see the Art Jetter and Company organizer is on there. Whoever's on that account, but I don't see a phone connection, so that's why sometimes I see that sometimes happen.
I'm wondering, because it's weird. It's not even letting us. Won't even let us hit start or nothing. Yes.
Try. I wonder if you take control back, if it'll let you start, and then you change me to presenter.
May have to. In fact, I'm debating. I may actually have to. Do we want to try and call back in?
Call back in.
Okay. Can you?
1 second.
Yeah, I'm going to go ahead. I'm going to disconnect for a second. Call back in. Okay.
Okay. We'll stay here.
Okay. Is everybody there?
Yeah.
Mm-hmm.
Okay. All right. We're good. All right. All right, good afternoon, everybody. This is Tony over here with Art Jetter. Sorry about the brief delay here. Anyway, just want to say welcome, everybody, to today's session with Nationwide. Today we are very pleased to announce we have Ms. Shawn Britt over here with us from Nationwide. Shawn comes over from Nationwide, having been there since 2000, and has been involved with life insurance and long-term care for over 25 years. Before I turn it over to her to get this rolling here for us, just want to mention we will be taking questions during this session, but we'll wait to the end before we do answer them, so please type in your questions as you go. But with that, I'd like to bring Shawn on the line here for you.
Thank you. Thank you all for joining us today. We're sorry for the delay. We had a little technical difficulty, but we are ready to go. So I hope at the end of this presentation, you will feel more prepared to talk to your clients about long-term care. And I'm going to start by saying that, we don't want to use statistics with clients. So what I have up here on this slide is really for your benefit. And, you see all over the place, 70% of people will need long-term care. It's really more like 52% versus 70%. So honestly, the only reason I bring it up at all is that we know only about 10% of your clients have long-term care, and they're not prepared for this. So this is a big opportunity for you. If 50% of people are going to need it and only 10% are going to have it, that means that there's about 80% of people in your client base that probably are prospects for this. So what is long-term care? Well, your clients, when they hear the words long-term care, they think of nursing home. So your clients actually think of long-term care as a place, and it's a place they don't want to go. So your clients really need to think of long-term care as an event. And when you present it that way, it sort of changes how they feel about it. It's a financial event that takes place like others. You know, you plan for college. If you have 5 daughters, you better be planning for weddings, because that's a lot of money to be spending when you have 5 daughters. These are things we plan for. We plan for private school tuition. Most importantly, we plan for retirement. And long-term care actually is part of retirement planning. In fact, it's the piece of the puzzle that if you don't plan for, it's going to unravel the whole retirement plan. So what do claims look like? Basically, about 52% of claims are for home health care, and 80% of people who start in the home often stay there. When you're presenting, like you're bringing up the conversation with a client, one way to bring it up is to say something like, Mr. and Mrs. Smith, as part of our chat today about your retirement planning, let's talk about how to keep you in your home as long as possible should you need a little help. Now notice, I didn't say long-term or care. I said help, because help is not a scary word. Even care, that starts the red flags with your client. We want them to think that you're trying to keep them in their home, not plan for them to go to a facility. Hopefully they will never have to. Hopefully they can choose what they want when it comes to their long-term care. But if you bring it up that way, let's help you plan to stay in your home as long as possible should you need a little help. All of a sudden that planning isn't so scary. And there's no magic number. How long does someone need? Should they buy long-term care? How long should their benefits last? There's no magic number. But what I can tell you is a good starting point for a plan. We know a claim that lasts 1 year will average 3.9 years. So let's round it up to 4. To me, a 4-year benefit is the bare bones minimum that you should be looking at. For women, I really like 6. Women are going to be in care about 50% longer than men. But that's a good way to plan when you don't have any other information to go on. For example, my godmother, she was the child of the second husband. Her mother had been widowed, so she had 2 half-sisters by the first husband. The mother and the 2 half-sisters all had dementia, and they all had it for 6 to 8 years. So she was always worried, and she was hoping she took after her father, who didn't have dementia. Well, indeed she did, but she was always concerned that she was going to have a 6 to 8 year care need. So for someone like her, she's going to want to plan for more like a 6 or 7 year benefit period. Other people may be comfortable with less, but between family history and some industry information, you can figure out what to do. And so I've already talked about this. We're going to talk about staying in the home as long as possible. So why do clients not want to buy long-term care? Well, one, they'll tell you they can afford to pay for it themselves. Well, that's fine if they only need it for a few months. And even if they can afford it, why would they want to spend dollar for dollar when they could use somebody else's money? They're used to maybe looking at traditional long-term care policies that they feel are expensive for what they're getting and too complicated. They're worried about price hikes, and they're worried about it being a waste of money if it's never used. But there's a whole lot of solutions today that are going to overcome all of those objections. And again, we don't want to talk about statistics, because the truth is you're either going to need it or you're not. If you don't need it, it was 0%. And if you do, it's 100%. None of that matters. What matters is what are the consequences if you don't plan. You can literally say to your client, well, I understand you don't think you're going to need long-term care, and you could very well be right. But just in case, I want to look at your portfolio and kind of go through with you what we would do, because I want to know now, while you're sound mind, what it is you would like me to do to help, your wife or your children or your husband and your children use your assets the way you would want. Once you start going through the consequences of paying for it out of pocket, they start realizing they need a policy. But one of the things to keep in mind when you're having these discussions is be careful about the words that you use, because the wrong words could insult a client or even disrespect the experience they had as a caregiver. So don't use words like burden or stuck. I mean, if you know that the wife of the couple you're speaking with was caring for a mother while raising teenage children, I may sound compassionate enough to you to say, oh, Mrs. Smith, I know how hard it was for you to be stuck in the middle. But you say stuck to her regarding her mother? Trust me, she's insulted. She may have felt stuck at times, and it's okay for her to feel stuck, but to be told she was stuck is not going to go over well. So you want to change the words. I know, Mrs. Smith, sometimes it was a challenge when you were caring for your mother and your children at the same time. And I would like to put a plan together so that your children may not face with having to juggling those same type of responsibilities. That sounds so much better than using words like stuck or burden. So you can have that same talk, just make sure you're using more respectful words. And remember, no matter how hard caregiving may have been for someone, it's also often an honor and can be enriching. Maybe not every day, but there are days you are so glad that you were in the position to take care of your mother. So you want to make sure that you provide very much respect. So your clients have a lot of misperceptions about how long-term care is going to be paid for. There's actually surveys showing where clients answer that Social Security is going to pay for their long-term care. Well, first of all, Social Security pays for anything you want it to pay for. But if you're planning to use it to pay for long-term care, you're probably going to have a big shortfall, because the average benefit would pay less than 15% of a nursing home bill, and maybe, if you're lucky, a third of assisted living costs. That is not going to get you your long-term care bills paid. And they also feel that Medicare is going to pay for long-term care. People don't understand that Medicare does not pay for that. They will swear their neighbor's mother was on Medicare for long-term care, and she might have been for 35 or 40 days, but it is not a long-term solution. If you can jump through the 3 hoops of fire to qualify, it'll pay up to 100 days, and only the first 20 are free. So it is not an answer. So what are other misconceptions? Well, first of all, self-funding. They'll tell you they can self-insure, which is literally impossible, because insuring is leveraging. Immediate leverage of $1. You cannot immediately leverage your own dollar. So you're really self-funding, which I call unsuring, because you're unsure of the time you'll have to save the money and unsure of the rate of return you actually get on the money you're saving. You have no idea if those savings are going to get where you need them to in time. It's possible for the wealthy, but it's not cost efficient for them either. Then for Medicaid, it is a plan for the poor. So it was intended for our more impoverished citizens. You have to have less than $2,000 in countable assets to be able to qualify. And Medicare is very different from Medicaid. And as I said, you're going to pay a significant copay days 21 through 100. It's going to be, your copay is going to be $9,000 a month. So it's, your copay is going to be nearly $6,000 a month. It's certainly not anything that, it's not a good plan. And again, it's only up to 100 days. Then you've got a lot of people who believe their health insurance is going to pay for it. Health insurance covers illness and injury. The only health insurance that even comes close to covering long-term care is Medigap, and the only thing it covers, if you have one of the higher end policies, is that Medicare copay. It does not actually cover the cost of care. So what will help for pay for long-term care? That would be a standalone policy. Long-term care, sometimes known as a linked benefit policy, that's a long-term care policy with a life insurance component that makes sure your premium is never lost, or a life insurance policy with a long-term care rider. So think about how long-term care is actually paid for. It's paid for in one of three ways. Either your lifestyle, and that's the potential loss of health, well-being, or earning ability for a spouse or other loved one who takes care of you. Or it could be paid with income. Problem with that, it's a dollar-for-dollar expenditure of your own money. Or you can use insurance, which is a cost-efficient leverage. Disposable income, yeah, maybe it's the source. The problem is, remember, assets create income. And if you start draining the assets, you lower the income they're able to generate. So there's less income for the surviving spouse. There's less inheritance for the kids. So long-term care insurance or coverage is going to help cover you from having to touch your assets. There's also the cost to unpaid caregiver, such as, the lifestyle cost. If you think about people caring for an Alzheimer's patient, 40% of the people who provide care for an Alzheimer's patient, which are generally the spouse, are going to predecease the patient. And your average caregiver is going to be a middle-aged woman who works full-time, or at least she did. She may be giving up that job or reducing her work hours, passing up promotions. Some people even get fired becoming caregivers because they can't handle everything. And they lose an average of $324,000 in lost wages and benefits. It's a snowball effect. If your income goes down, your pension, if you have one, goes down. Your Social Security benefits will go down. And even if you try to go back to work, you very seldom can replace what you had. And then they lose time with their family, and sometimes that creates stress with their relationship with a spouse or even children. So who is your typical long-term care buyer? Generally, well, first of all, I'll tell you, anybody who's willing to buy, we want them to buy. You're never too young. But your typical audience for this is going to be ages 50 to 64. The reason is they're in the height of their earning career, their earning capacity, and their career. They're still working, which means income is coming in to pay for it, and they're still healthy. All three of those make them better candidates. Now, if they're married with adult children and own a home, that's a better candidate. There's more to lose if long-term care starts devastating their portfolio. A white-collar professional not yet retired, that's more about the affordability and, again, still working. If they own life insurance or other conservative investments, these people are natural risk hedgers, which make them a better candidate for not having, they're going to be more on board with this without heavy convincing. Household income of $100,000 or more, that's relative to where you live, but what this really means is, can they afford a policy? But your best chance is with people who have experienced the challenges of taking care of a relative with long-term care needs. They already know what the consequences are. They've experienced them. So if you can have a box of Kleenex on, and I'm serious, have a box of Kleenex on your desk and sit it where you think the female client is going to sit. If she, make it comfortable for her to get a little emotional about her story. Ask her about her story. Her story is going to help her understand she needs to buy a policy to protect her children. And if she gets a little teary-eyed when she sees that Kleenex box, she won't be embarrassed. She'll know it's safe to tell you her story. So have that box of Kleenex ready. Now, the differences between men and women. Women generally are more interested in long-term care than men. They drive the sale. When you're in an appointment, if both the male and female are sitting with you, get the female to speak first. Get her to tell you first what her concerns are. Usually she's the one who will want it, and he isn't. Sometimes it's reversed, but if there's one of the spouses don't want it, it's usually the male. And a lot of times they're fine with him buying a policy, but it's her buying a policy, but he doesn't think he needs one because he's married to his long-term care. In other words, he sees no problem with her taking care of him, but he realizes that he won't be there to take care of her. So it's okay for him to buy a policy. Remind him that when they're 78 and 81 years old, her bathing and dressing him is going to be very hard for her, and maybe a small policy to pay for the heavy lifting would be appropriate. Again, what are the consequences of Marge taking care of you? What if she falls getting you out of the shower? Then you're both have a problem. You don't need a big policy. Let's get you something small. And that oftentimes will help get them over the edge. But the type of policy that people buy is interesting because, again, women will buy, they like all long-term care policies for the most part, but men, they don't really like traditional policies because they see them as a waste, which is why 2/3 of traditional long-term care policies are purchased by women. Now, if you move to a linked benefit policy, which for those of you who don't know what that is, I'm going to show you in a minute. But because your premium is protected, men are a little more open to that. Men tend to be most open to a long-term care rider with life insurance because they're convinced they're not going to need it. And if they don't, the full life insurance leverage pays to their heirs, so they see that as a good investment. Women and long-term care is kind of a double-edged sword for them because they're caregivers as well as the cared for. So if you look again, women comprise about 2/3 of long-term care claims. 75% of unpaid caregivers are women. These are the ones doing the heavy lifting. Men are helping, but men are more likely to, if they go out to eat at a restaurant, maybe he helps mom get into her wheelchair, or he pays her bills, or he takes her to the doctor. But he's not helping her with bathing and dressing and other personal care needs and the heavy lifting. Those are the women that are doing that. Women are going to live an average of 5 years longer than a man, so they're more likely to use their policy. And they're going to be on claim about 50% longer. And moreover, 74% of women who are to age 75 or more do not have a spouse to help with their care. But that only applies to 24% of men. 24% of men are alone. 74% of women are alone by age 75. So for women, the planning is even more important. So what can you do to help your clients? Well, there's a lot of solutions. It depends on how much money they have, where the money's coming from, what kind of guarantees they want, what other planning needs they may have, but you have a lot of solutions. So we're going to go over those briefly, and we'll start with a traditional long-term care insurance. Very easy. It's one bucket of money that's only available for long-term care benefits. You pay your premium, you have your benefit pool. There's a lot of features you can add to it. Today, most of them are reimbursement. It's very hard to get a traditional policy that will pay by indemnity. Most of them will only reimburse expenses. They are subject to rate increases, and it's hard to find there's only one company I know of today that'll take a single pay. Most of them, because of the low interest rates, want you to do the life pays. So you don't have a lot of variation in how they're paid for. Then you have a life insurance policy with a long-term care rider. This is also a one bucket approach. Sometimes it's one bucket approach with a little bonus with some companies. And what that means is you have a death benefit. Your long-term care benefits are paid from that death benefit. So if you have a $200,000 policy and you go through $100,000 of long-term care, and then you die, the other $100,000 is paid to your family. So there's whatever that death benefit is, it's all paid. It's a matter if it's paid for long-term care or if it's paid as a death benefit. And some companies even have that little bonus bucket, meaning if you go through all of the death benefit, they might have a little, depending on the company, one company will give you 10% of the original death benefit with no cap. Another company might give you 5% with a maximum of $5,000. But some companies will have that little bonus bucket if you go through the money. They're the least customizable, but there's a lot of life insurance. Men like this because you can say, and you can show them the rate of return on the death benefit, and you can buy these on guaranteed products. You can guarantee there's no rate increase, no benefit decrease. This is how much it's going to pay, and all we don't know is when you're going to pass away or need the money for long-term care. But here's your rate of return report, which is going to show you exactly how much money this policy makes. They like that. That's why men are more likely to buy this policy. You can literally lay out how it's going to work, what the rate of return is, and literally sell it as an investment versus long-term care insurance. This is a linked benefit policy. These policies have a life insurance base, but they're not intended for life insurance protection because the life insurance is really designed to protect the premium from being lost and nothing more. So you're not getting true life insurance leverage here. You don't sell this to people who need life insurance. This is for people who need long-term care. And in this, there's several premium schedules that are available for these products. I'm showing a single premium here. So we have our 55-year-old female. She spends $100,000. Her death benefit's $197,000 if she never needs the policy. So it's not bad. It's definitely every bit as good as putting it in a low-yielding investment. But if she does need long-term care, the first money will be paid from that death benefit bucket. But if the death benefit gets eliminated, she goes to the second bucket. That bucket's only available. In this case, I'm showing a 6-year benefit, so the second bucket is for 4 years, and it's only available for long-term care. So that second bucket, whatever's left in that bucket will be gone when the insured passes away. So the first bucket is guaranteed to pay, live or die. The second bucket is for long-term care only. But potentially, in this case, they could collect $591,000 of LTC benefits. Plus, it's guaranteed. Most of these policies have a minimum death benefit. It might be 10%, it might be $5,000, or it could be as high as 20%. And Nationwide does 20%. So with them, it would be a little higher. But again, it's that guaranteed on the back end death benefit. Now, to qualify for a long-term care plan, you need either cognitive impairment, which can be Alzheimer's, dementia, brain damage, that type of thing, or 2 activities of daily living impaired, which are those standard 6 of bathing, dressing, continence, eating, toileting, and transferring. And they need to be, the doctor needs to believe they will happen for at least 90 days. Cognitive impairment alone will qualify you. Some people think if you have cognitive impairment, you have to have one from the other list. No. Cognitive impairment all by itself will qualify you. And elimination periods are going to vary by the carrier, but they run from 0 to 100 days. Some carriers are service days. Some carriers are calendar days. So that's one of the things you want to know, how many days and whether they're service days, meaning that it only counts if a care provider came to see them, or if it's calendar days. Probably one of the biggest things that it's important for people to understand is how benefits are paid. So there's basically 3 ways. Reimbursement plans only pay the actual long-term care costs. Bills and receipts have to be submitted to determine how much is reimbursable. because they're only going to reimburse what's covered under the policy. Some of the insurance companies allow third-party billing, and what that means is, let's say you're staying in an assisted living facility. The assisted living facility is allowed to bill the insurance company directly. But not all facilities will do that. Not all service providers, home health care agencies, a lot of them want to bill the actual responsible party. So that may or may not actually happen. So you have to keep that in mind. And then there's benefit limitations. Non-qualifying services not covered under the policy will have to be paid for out of pocket. And generally, licensed providers are required for some or all, usually most, of your care, with a few exceptions. Now, a lot of people don't realize there's a difference between indemnity and cash indemnity, but there is. So the difference is this. The term indemnity, just indemnity, means you will get whatever your policy says your benefit is. So if you have a $5,000 a month benefit, you'll get paid $5,000 a month. But you still may have to do other things to get it. Some companies will ask you to send proof of one bill. They don't care how much it's for, as long as that bill was from a licensed provider, because they require some of your care is by a licensed provider. Other companies won't make you send it, but they still will require you to use a licensed provider for some of your care, and then leftover benefits can be used any way you want. With cash indemnity, it's exactly like it sounds. It's cash. No restrictions by the insurance company on how it's used. So you can pay your daughter to take care of you. If your spouse is taking care of you, you don't pay anybody to take care of you. You can literally do whatever you want as far as paying for your care or not paying for your care, but you get that monthly amount that your benefit is. Now, chronic illness rider, they are similar but not the same as the long-term care rider. They still require the severe cognitive impairment or 2 out of 6 activities of daily living impaired for at least 90 days. However, many of them also require that the claim lasts the rest of the insured's life. Today, the rules changed. Some chronic illness riders will pay temporary claims, but a lot of them are still using that forever rule, meaning you'll find somewhere in the contract where it says the insured must be considered to need care the rest of their life. So you want to make sure, if you're looking at a chronic illness rider, that it will pay a temporary claim, because a lot of them don't. So basically, chronic illness riders cannot be marketed as long-term care. They can't. They're not the same thing. They don't have the consumer protections. Some of them won't pay temporary claims. You never get a bonus bucket with them. There's a lot of differences that people really don't understand. And then some of them have a discounted method of paying benefits, which is a big surprise that nobody expects. So when you're working with a chronic illness rider company, there's a lot of questions you want to ask to make sure everybody understands how the benefits are going to be paid. As far as tax ramifications, qualified long-term care benefits are paid tax-free within IRS qualifying limits. So what that means is you can collect the greater of the HIPAA per diem for the year of claim or your actual long-term care costs incurred. You get the larger amount. If you're collecting for more than one policy, then it's not per policy, it's per insured. So they're going to take all if you're collecting from three, like I have 3 policies. I buy long-term care like dresses, but that's what I do for a living. So I have 3 policies. If I were to collect from all 3 at the same time, the IRS wants me to add up all 3 benefits. And then they're going to use that formula, cumulative of all 3 benefits. So buying numerous policies is not going to get you more tax-free money. If you have multiple owners, they always tax the owner, even though the formula is based on the insured, who the insured is, they tax the owner. So the insured, if they own one of the policies, would have first rights to the tax-free money, then they'll split any taxable amounts amongst the other owners on a pro rata basis. And, as I said, not all policies are the same, so make sure that you read the contract. We've talked about all of this, so I'm not going to go over it again, but read the contract. Nationwide has a LTC cost assessment. You might be interested. We also have an app now, which is not on this presentation, but we can get you information. You can download the app to your phone, and literally on your smartphone or computer, you can get an estimate based on where you live, how much their long-term care costs will be, or future inflated values. If you want to do it through the assessment, that can be faxed to you or emailed to you, and it takes about a 48-hour turnaround. It's just a page of yes/no questions. It takes about 5 minutes, and that's going to give you a report similar to what you might get on the app. But what it's going to do is tell you how much the cost of care in your area will be at such time. The difference you're going to get with the assessment is based on how you answer the health questions. They're going to estimate when you're going to need long-term care. So if we look at John and Jane here, John isn't as healthy. They're going to assume that he's going to need services around 77, whereas Jane, looks like I forgot to change my little, I apologize, on the side. Jane's going to need it a lot later than he is. She's a healthier person, so it's going to be longer before she needs long-term care. Her bills are also going to be higher because inflation is going to kick in for a longer period of time. So this can help you plan for costs, as well as an estimate. It's just a general estimate based on some general health questions. And please know that Nationwide is not the one that is, they're not the engine behind this. It is a third-party health service that analyzes these for us. So you can be sure that there's an objective viewpoint that you're getting for your client. But you can find out then about what time they might need long-term care based on their health. Of course, nothing is guaranteed, but in general, that's kind of what they're looking at. So John's looking at needing long-term care at a much younger age than his wife Jane is in this example. So we want to customize our solutions. First thing we want to do is, how do we pay for it? This slide here gives you a good idea of places you can go for money. CDs that are maturing. I bought my third policy I bought with an inheritance when my mother passed away. Bonds that are being called, excess liquidity that someone may have on an annual basis. You can read all these things here. One of my favorites is the low yielding asset. A lot of your clients have that investment they made 20 years ago. Lord knows, my dad bought this gold mine in Canada. And my mom and I used to always make fun of them because they never struck gold. But he just would not sell that thing. He would not get rid of the investment. And so if your client has that non-producing gold mine in Canada or something similar to that, maybe you can show them how to turn that money into a new gold mine, being long-term care coverage. So there's a lot of things here that you can do. When it comes to using annuities that aren't needed for income, you can repurpose that annuity. In this case, our client was 60 years old, and she had an annuity worth $100,000 with a $68,000 cost basis. That annuity was then turned into a 10-year term certain payout. You can either 1035 it to a SPIA if that payout is better, or see what the payout is where the new annuity currently is held. Either way, set it up as a 10-year term certain payout. In this case, the payout was $10,826 a year. After taxes, she had $96.12 left. She bought a life insurance policy with a long-term care writer. Her death benefit was $254,900. That was going to supply her with $5,098 per month for long-term care purposes. But if she doesn't need it, we took $100,000 annuity money that was partially taxable to the heirs and turned it into $254,000 tax-free dollars to her heirs. Whatever's left over will be paid to the heirs. So this is a good way to take annuity money not needed for retirement income and repurpose it into a better leverage. Here's a case where we had a client with a CD. And, you know, the problem with CDs is, one, you can't get one that has any decent interest rate. I show 3% here, and I don't think you can find anything for 3% or even close to it. But if you look at $100,000 in a 3% CD with the taxes on the interest paid out of pocket every year, at age 88, which is past the typical time she would need long-term care, it's only worth $228,000. That's what I was talking about when I say self-funding is unsuring. You're unsure how long it's going to take to get where you need to be. It's going to take her until she's 115 years old to get to where the linked benefit policy would have her upon her first premium payment. I didn't put inflation on this example. It bought a nice pool of money without it, but she's got $509,000 ready to go right now. And if she never uses it, this particular policy had a back end bump of $33,000. So even if she went through all of the LTC, there'd be a little bit of a death benefit. If she doesn't use it, the death benefit is $169,000, slightly less than how much the CD would have been worth at death if she never used it for the policy. There isn't that much difference. A little bit lower, but not that much difference. And think about, it's a small downside and a huge upside. This is a good plan for a client with CDs who think that is their long-term care money. You can also insure an unhealthy spouse when you have a cash indemnity policy. So let's say you have, whether it's a long-term care rider on life insurance or a linked benefit policy, the death benefit becomes a key caregiver insurance. So let's say you have a husband and a wife, and the husband's uninsurable. Then you load up the wife. I like using life insurance with a long-term care rider best, though sometimes the linked benefit policy with inflation works well too. But think about this. You buy a $500,000 life insurance policy with an LTC rider. The wife is supposed to take care of him, but she unexpectedly died. He now has the death benefit of $500,000 to pay for his long-term care. But if, let's say he doesn't die, he needs care, she starts caring from him, and caring for him starts eroding her health, and now she goes on claim. As soon as she is on claim, she's going to get $10,000 a month from that policy, and she can use that money to take care of herself as well as take care of her husband, because it's a cash indemnity policy. Therefore, there's no restrictions on how she uses the money. So this is a good way to deal with a couple where one of them is uninsurable. So we're going to go ahead and open this up for questions now.
All right. Well, Shawn, thank you for that. I've got a few questions here for you. Looks like our first question here. It says here, can the claim be made for someone outside the country if the U.S. licensed health practitioner sees them abroad?
Yeah. So you have to check with your insurance company. Our company does allow that. Legally, a U.S. licensed healthcare practitioner must do the assessment and write the plan of care. Legally, no insurance company can take a foreign doctor. They can be a foreign doctor as long as they are licensed in the U.S. to practice. So for example, you might have someone who came over from China, went to medical school in the U.S., maybe practiced here for a while, went back to China. Usually they hang on to their licenses. They don't let them go because they're coming back and forth. So that would be an example of how someone in China might be licensed to practice in the U.S. But check with your carrier because not all of them will allow it, but it can be done.
All right. Well, it looks like our next question here for you it says, is it possible to use HSA funds to cover long-term care premium? And if so, does it matter if it's a tax-qualified or non-tax qualified policy?
Excellent question. So most policies, first let's break up the question. Most policies today are tax qualified. Even if they're chronic illness riders, they're tax qualified under 101G. It doesn't make them long-term care, but it does give them tax-free benefits. No chronic illness rider can be purchased with HSA money. So we'll take that one off the table. So now let's go to long-term care. If the cost of the LTC riders are paid for with separate identifiable premiums, the answer is yes. But most of them are not. So if you have an LTC rider on life insurance, other than a few whole life companies, the way it's done is all the premium goes into the cash value, and then all of the policy charges are taken as deductions from the cash value. When it's done that way, the Pension Protection Act is very clear. You cannot use HSA money. So virtually all long-term care riders, unless it's from a whole life company, and then you still have to check with them. Whole life has a different way of doing things, so some of them by default qualify. They didn't intend it to, it just happened. But if it's a long-term care rider on universal life, variable life, etc., no. However, there's a couple of linked benefit policies. Nationwide has one of them. Ours is Care Matters 2, not even our first Care Matters, but just our second version of Care Matters, where we use separate identifiable premiums. And what that means is when your client sends the premium check in, it's literally, think of it as we cash the check first, and then we take the money for the LTC rider charges, and we put that right into the general account, and only the life insurance money goes into the cash value. By doing it that way, HSA dollars can be used up to age-based limits, just like a standalone policy.
Okay, all right. Well, it looks like our next question has come through here. It says, is it true that the underwriting process has become more strict and that we have fewer carriers interested in offering long-term care policies? And if so, why is that?
So that's also a two-sided question. So if you look at the traditional long-term care market, yes, underwriting has definitely become more strict. In fact, we're finding that the decline rates for younger ages have increased substantially over the last 15 years. And the reason is that the standalone companies are learning more about how to underwrite. Remember, long-term care is a young business. It's been around a little less than 50 years, where life insurance has been around since ancient times, and even in a modern sense, it's been around for 300 years. So actuaries know exactly how to deal with life insurance, but it's taken them, 40-some years to learn exactly how to price and underwrite long-term care. So yes, they have become more stringent. Plus, with the low interest rate environment, there's less wiggle room for failure. And with a traditional policy, if they have to pay a claim, they lose, period. Now, if you look with linked benefit policies and life insurance with long-term care riders, those have a life insurance chassis on them, which means a lot of the money that's going to be paid has to be paid one way or the other because there's a death benefit. And that's what's used for the long-term care benefits. So the risk to the insurance company is mitigated by the long-term care. So you actually have a little better chance of getting underwritten when you're using a combo product, meaning it's attached to some type of financial product, then you do a standalone policy. Because the life insurance foundation helps lessen the risk for the insurance company. Excellent question. Thank you for asking.
All right. Well, Shawn, looks like we've got one question on one of the illustrations you went over. It says, I was curious on Shawn's illustration on the 100,000 single pay design of the 55-year-old lady that she didn't show an inflation rider. Now, it says, I realize that provides a higher monthly benefit, but at age 55, doesn't it make sense to add a COI rider?
Absolutely, but it makes it harder to make a slide. I'll just be honest. We usually, when we're doing slide presentations and doing comparisons the way I did, it's hard to show inflation. But no, inflation can be very important. And, what we're finding, people will, I'll just kind of piggyback off that question. Inflation is important, but people will ask me, well, what kind of inflation should you add and when should you add it? Well, if you're buying, if you have a 45-year-old buying this, absolutely put inflation on it. When you have, when I bought my third policy, I was 61. And I considered inflation. And then I thought, my husband and I have these life insurance policies and we're not going to get rid of them, but we don't really need them for what we bought them for. And I realized I don't need inflation. He's going to die before I am. And that's my inflation. Whether it's putting back into my portfolio money I had to pull out or it's already there. So, inflation becomes, sometimes you have to look at it as a case-by-case situation. Yeah, a 45-year-old client, 50-year-old client, put inflation on it. But you get to a certain age, you got to look at everything that they have. And if they've got life insurance policies that you're not going to get rid of, they put too much into them and you don't want to cash them in, that death benefit could be the substitute for inflation. But yeah, the reason I didn't put inflation on there is because it makes it complicated. I can't fit it all on the slide. But yes, it's very important to consider inflation. Thank you for bringing that up.
All right, Shawn, looks like I got a couple more questions here for you. This one asks, can you go into an example of replacing a whole life policy for a 77-year-old to a policy with a long-term care rider?
Yes. Now, first of all, you've got to, so I'm assuming when they say age 77, they have a case. So first of all, you got to make sure that the company will take a 77-year-old. Some of companies cut it off at 70, some cut it at 75, some will go to 80. Nationwide will go to 80 on their life insurance policy with an LTC rider. But on the linked benefit, we only, right now, because of COVID, we only go to 69. So first of all, you got to find a company that will do an LTC rider for 77-year-olds. So that's the first thing. So basically, it's like any other 1035 exchange. You simply, you get an illustration from the new company, have them add a long-term care rider to it, and you're going to 1035 the whole life money to the new life insurance contract. There's literally no secret. There's no extra trick, nothing new to learn. It's a 1035 exchange. Remember, when you have riders on life insurance or annuity, the 1035 rules follow the base product. So because you have a whole life policy and you want to 1035 it to a life insurance policy with an LTC rider, you can also 1035 a whole life policy to a linked benefit policy as long as the linked benefit policy has a life insurance, not an annuity base. But you're not going to find anybody, there's no linked benefit policy that will take a 77-year-old. So you're going to go to life insurance with an LTC rider. But it's a standard 1035 exchange. There's nothing new that you need to know. Just a standard exchange. So, you'll do the usual 1035 paperwork and submit the case.
Right. Well, we're getting lots of good questions here. I got a few more for you here, Shawn. Says this one here, the older linked benefit plans had a full return of premium Does Care Matters have any kind of ROP option?
Yes, we have 3 of them. So a lot of the companies, what we found out is we could pay more long-term care benefits if we got rid of the day 1 ROP, because the truth is very few people ever cash them in. Most people weren't concerned about that. And the majority of people who do cash them in do it during the 30-day free look period. So even though it has a life insurance-based long-term care products that are sold with the intention of like a linked benefit policy, has to follow more of the true long-term care regulatory requirements, and that requires a 30-day free look period. So what we have found over time is the majority of people who do cash them in do it during the 30-day free look period, which means it's like an annulment. It never happened. Therefore, they get all their money back. Once that 30 days has passed, now they're either in their return of premium feature or surrender period. So, for example, Nationwide has 3 options with their newest rendition of Care Matters. You can do the vested schedule. What that means is on a single pay or a 5 pay, in year 1, if you want your money back after the first 30 days, you would get 85% back. Each year that would go up by 3%. So at the end of 5 years, you would get 100% back. If you have a 10-year schedule, it would be day 1 of year 11. Also starting at 85%, but it's, a little slower. You can also do the next one, which is, and if you do that vested schedule, you get the least in LTC benefits, but the most generous liquidity if you're worried about that. Then we have the 80% all years until day 1 of year 11, you get it all back. If you want the most benefit, you just go by the surrender schedule. And 83% of our policies are sold with what we call the maximum benefit minimum refund feature. So you eventually will get your money back. You just have to wait a lot longer for it. So we give people now those 3 options so you can get it back in as little as 5 years, get it all back, or just not worry about it. But again, most of the people cashing these in will do it in the first 30 days.
All right. Well, let's see here. I got another question here for you, Shawn, that says, is it true that the Nationwide Care Matters new business rates are increasing on May 10th? Is that correct?
That is correct. What's happened is that everything going on with COVID has destroyed interest rates, and everybody's going to reprice. Unless they just reprice anyway, everybody's going to reprice. The most susceptible is the single premium. We simply cannot afford to invest single premiums at the current Treasury rate. It's just, you just can't do it. What you're going to find is also, some people think get the most bang for your buck, do a single premium. I have another program I talk about where actually it might be better to do a 10-year premium for a lot of reasons. 1, it keeps more in your portfolio to grow back and grow forward. And 2, the difference, what you're going to find after the reprice, the difference between a single pay and a 10 pay is going to close. In other words, right now, a single pay may look far more attractive. It won't with all the companies. The companies they don't want the single pay money. They just don't want it. So yes, that is what's going to happen. Absolutely. With us and everyone else who hasn't already done it.
All right. Well, Shawn, I think I've got just a couple more questions here, but the next
Sure.
one here reads, says, what do you think about life settlements for funding long-term care?
It's a way to do it. I'm not against it. Those are situations where you have to look at everything on a case-by-case basis and see if it makes sense. The same thing, I get the same question. People ask me about reverse mortgages. And I'm kind of like, it kind of depends on the client. The one thing I don't like, people will ask me, well, can we do a reverse mortgage and then use that to pay for a long-term care policy? I get a little squeamish about that. It's like, you all remember back in the 90s when you could throw a dart and pick a mutual fund or a stock and it would do well, and people were taking out second mortgages on their house to get into the market, and then the market crashed and they lost their money and they owed more on their house. So, I don't like pushing some of those concepts too far personally. But again, you have to, I'm not going to say yay or nay. It would kind of depend on your client's situation. It might work for them, where another client, it may not be the most suitable idea.
Okay, well, looks like we're down to our last question here, Shawn. It says here, now I've had at least 4 rate hikes on my existing policy. I have formally complained to my state insurance department on several of the increases to no avail. Doesn't this create a negative viewpoint of the product? As an agent, how do you overcome this issue? Your thoughts?
Oh, absolutely. This is why Nationwide from day one has always, regardless of which product we have it on, we've always tried to offer at least one variation that would allow you to have guarantees. You can literally buy a VUL with a long-term care rider and a guaranteed death benefit and a guaranteed LTC benefit. So even if the cash value goes defunct, you still have that guaranteed death benefit, guaranteed LTC, and you don't have to pay any more money as long as you paid the premiums we asked you to. I mean, we're very sensitive to that at Nationwide. And the problem is a lot of the clients, they don't realize there's other solutions besides the standalone policy. So they have this real bad taste in their mouth. They go to bridge club. They hear about my mother-in-law. My husband sold her some policies. She had 2 policies. And one of them was, you'll know how old this policy is when I tell you, it had a return of premium feature even if you use the policy. Obviously, that company doesn't exist anymore. But she would call. She had 5 price increases. She'd say, I'm not paying the premium. They want more money again. And Mike would say, Mom, pay the money. I get it back when you die. Just pay the money. And if you aren't going to pay it, I am. Just let me know. So she'd write that check, but he'd have to every time tell her that. Well, sure enough, she used the policy. She used more of it than she ever paid into it, and we got all the premium back. And again, that company isn't here. That's one of those lessons that had to be learned. But, she was like, by the 5th price hike, she was done. And if it wasn't for the fact that we knew how her policy worked, she would have let that thing go. So yes, clients have a very bad taste in their mouth, and you have to resell them on the new long-term care, that is totally guaranteed because it has a different foundation that backs it. And that can be a little hard for clients who maybe have been burned after dealing with a parent situation. We run across that all the time. But hopefully we all have a lot of, Nationwide as well as other companies have some good literature on our hybrid solutions that can put your clients at ease and clearly state that they have those guarantees so they don't have to worry.
Okay, well, Shawn, looks like I have one more question that kept in here. I guess, if you don't mind, it says here, traditional long-term care plans now have much higher premiums for women than men. Life policies usually have higher rates for men. Now, where do the linked benefit and chronic riders stand in terms of male and female premiums?
Very good question. So your chronic illness riders are your long-term care riders and your chronic illness riders. So I'm going to take linked benefit and make that as part 2 of the question. So your long-term care rider and your chronic illness rider are priced exactly the same way. They are predominantly life insurance priced. Remember that it's just a rider that you pay for the fact that you might collect your death benefit early. So your males are still going to cost more. Their rider is cheaper, but it's such a small component of the policy, you're not going to notice it. They're same everything else. All else equal, the male will always have a higher premium on a long-term care rider or a chronic illness rider on life insurance. But now when we go to linked benefit policies, that's going to change based on how long the benefit period is. So let's take Care Matters 2. The life insurance component on that starts with 2 years. So all policies have a 2-year first bucket. That's death benefit. So if your client only wants 2 years of benefits, I don't know why they would do that, but let's say they do, the males will always be more expensive because it's based on a life insurance. When you get to 3 years, it's 2 years of life insurance and 1 year of long-term care only. The males are going to be just a hair more than the female. And at 4 years, the females become a little more than the male. But you get to 5, 6, 7 years, the females are going to be a lot higher than the males because the majority of the policy is based on long-term care rates. So you're whoever wrote the question, you're exactly right. Long-term care rates are higher on women because they live longer, and the longer you live, the more likely you will need care. Females are 50% more likely to file a claim and will be on claim 50% longer. So long-term care rates are more expensive for women, but you're not going to notice that if it's just a rider on a life insurance policy, whether it's long-term care rider or chronic illness rider, you're not going to notice it much because it's a small charge versus a linked benefit policy whose intent is to supply a lot of long-term care coverage. Then you're going to see the women cost more unless it's a 2 or 3 year benefit period.
All right, and then let's see here. I think got one more here for you, Shawn. We have a very lively group here. A lot of good questions.
I've got to tell you, one of the best groups I've ever had. I love you all. This has been fabulous. Keep going.
Let's see. Is there an age sweet spot for male and female to get the plans? Say a 10 pay.
It depends on. Every company has their sweet spot. They vary a little bit. Generally, though, for all companies, anything 65 and under. Once you get over 65, remember, they're not going to have as many years. They're not going to have as many years to pay before they need care. So the policies become more expensive. And getting them before by the time they're 65 is important for several reasons. One, they're still working, so they have the money to do it. 2, they generally are still healthy, so they're going to get approved. And I have a third one. It just went right back out of my head. And just the insurance companies have the opportunity to, if it's a 10 pay, even by the time the 10th, like if you're 60 years old, you've paid your 10th premium at 70, that money's still cooking for 10 years before you need that policy. But if you're doing a policy when you're 70, like as I said, we've stopped at these 70 to 75 for at least for now. But even at 69, you buy a policy at 69, it's only 11 years before you're likely to need that policy. So once you get over 65, it's just not I'm not saying not to do it. It's still better than nothing, but it's not going to be as attractively priced. It just isn't for anybody, any company.
All right. Well, it looks like that might be the end of our questions there, Shawn. Just want to say thank you for everybody for joining our session here today. Great questions, everybody. Definitely a very lively chat as far as that goes there. Also, Shawn, thank you very much for joining us here today. I think outside of that, if anybody has any questions going forward about today's sessions or anything to do with long-term care and or Nationwide, certainly contact myself or Brittany here in the office anytime. Outside of that, again, thank you everybody for attending, and have a great day.
Thank you all so much. I really appreciate it. It was fun. Thank you.